Hello everyone. In this video, we'll talk about what can we learn from the world's greatest investors. So we'll talk about these investors and their investing philosophy in particular, and what is in it for us that we can learn from them and improve our investing philosophy. So basically, in this video, we'll talk about investors like Ben Graham, Phil Fisher, and John Maynard Keynes. And the reason I've selected these three investors were because they were the ones, who have seen, who have witnessed few of the critical events in the history of in the entire history, basically in the modern history, and very much from history of capital markets as well. So basically, the first point, as it says, is that their investment philosophy was primarily molded by these critical or these important historical events. So when I say events, the events were like First World War, which was basically from which lasted from 1914 to 1919, and then there was this great market crash in US and all over the world from 1929 to 1932, which was followed by a Great Depression again in US primarily and across the world as well, and then subsequently resulted in Second World War, which again lasted from 1939 to 1945. So basically, all these investors that I have mentioned, they have seen, they have witnessed these important events which were happening over a period of, let's say 20, 25, 30 years. So they're investing. So all these events had a very important effect on how they shaped their investing philosophy. And as we can see that, specifically talking from capital markets perspective, that after the First World War, that was that got ended in 1919. There was basically a 10 years bull run, or there was a huge rally in US Dow Jones from 1919 to 1929. Basically, what they say is the roaring 1920s, roaring 20s as it is called in US. So basically, there was this 10 years strong rally from, as I mentioned, from 1919 to 1929, and there was a huge speculation going on. So it is not like what we see now, that although the speculation still exists, but then it is not as much as used to happen in the 20s and 30s in US and other markets, developed markets. And there was rampant speculation in the entire market, and there wasn't this concept of institutional investors, and SEC, which is Securities and Exchange Commission. So all these things were not, so all these people, the actions were not in place till 1934s. And before that, there was this entire speculation which was happening in the market. And as a result of that, what was happening is, after the 10 years of bull run in US from 1919, that was after the First World War got over, till 1929, there was this bubble which was forming up for the as I mentioned, this in this 10 years of this great rally. And then subsequently there was this bloodbath in the market, with Dow Jones falling around 90%, 89.2% to be specific, from its peak of 381. That was in way back in 19, I think 29, yes, September 1929, and then it fell from 381 to 41. So in a span of close to 3 years, or two years and 10 months, the basically the index, so I'm talking about the index. I'm not talking about particular stocks. The index itself fell from 381 to 41, roughly around 90%. So you can see that so much of damage has happened. I mean, so much of damage was done in the in the capital markets, and and a lot of people got affected with that. So basically, so when I say that, Ben Graham and John Maynard Keynes in particular, they all these people, they lost a significant amount of wealth during the Great Crash. So Ben Graham, as it is mentioned in Intelligent Investor, that he lost roughly around 70% of his net worth in the Great Crash, and for John Maynard Keynes, he lost around 80 to 85% of his wealth during this market crash. So basically, all these people were severely affected by that, and that is the reason it is important for us to learn from them, because these are the people who have witnessed such uh, gruesome events, which has led to their shaping of the investment philosophy. And especially for John Maynard Keynes, that the market crash had an enlightening effect on him. And as we'll talk about him in particular, that he started he started basically as a speculator, where he was speculating on commodities and currencies and all. And then post this crash, it was like chastening effect, wherein he was transformed to a value investor. And we'll talk about his investing philosophy in the slides to come. And all these events basically they had a huge transformation if or a huge huge effect on their investing philosophy, wherein they tried to protect the limit downside first. And I think it is the basic tenet of value investing, that instead of going for instead of going for appreciable returns, or instead of going for capital appreciation and all, the basic thing what all these investors do is that they limit their downside risk. That instead of going for returns, they should not lose money. And as Warren Buffett has mentioned multiple times, that first rule of investing is don't lose money. Second rule is don't forget the rule number one. And that is what is the value investing is all about, right? So all these events were actually responsible for these investors to shape their philosophy and ensure that the downside is protected before you look for the returns and all. So now we talk about the first investor that we have profiled in our video, who is Benjamin Graham. And I think I've spoken multiple times about Ben Graham, who was also known as father of security analysis and was a mentor of Warren Buffett, who was, he was a professor in Columbia Business School, and Warren Buffett was one of his students. So basically, Ben Graham is, Ben Graham is wrote this book called Security Analysis in 1934, post the market crash of 29 till 32. And before that, these money managers or the brokers or these individuals, the high net worth individuals as we call them now, so all these wealthy people, they used to act like speculators, and there was no such concept of analyzing balance sheet or financial statements of a company, or analyzing the products or services that they offer. It was just a speculation which was happening throughout the market, and that was the result of the great boom from 1919 to 29, and the subsequent great market crash from 29 to 32. So it was Ben's book that he wrote in 34 along with David Dott, and this book is Security Analysis. And basically, in that, the first point he has tried to elaborate is that there are two types of people who participate in capital markets. So basically, these are the investors and speculators, and he has defined investing operation and what separates an investing operation from a speculating speculation. And his definition of investment is that investing operation is one which, upon thorough analysis, promises safety of principal and an adequate return. And again, you can see the impetus on the the you can see the stress on the word safety of principal. So that's what I was mentioning, that all these value investors first ensures that your principal is safe, and then you go for a return. So that is, I think that is one of the important tenets of investing. And operations which are not meeting these requirements are basically speculative in nature. And also, as I mentioned, as I've highlighted in the left chart, that basically the participants are of two types: investors and speculators. And within investors also, there are two categories that he has mentioned in his book, Intelligent Investor, that active investor or the enterprising investor. So there are multiple terms that he has used for defining the same category of investors. And the second category is passive investor or defensive investor. And basically, if we look like, in today's terms, that if if people are able to if they are able to spend some time and do some research on their own, then they would be then they might be called active investor. Then if people, they don't have time, if they have their regular jobs and all, if they don't have time to do analysis or research on their own, then they might fall into the category of defensive investor. And for them, it would be good that if they resort to mutual funds or index funds and all. So that is how he has presented all this way back in his book 1934. Now, coming to the greatest contribution that he has made in the field of investment is that he said that any investment operation should resort to a concept called margin of safety. And I think again I've discussed about this concept multiple times in most of my previous videos, that margin of safety is nothing but that you buy something for less than its worth. So let's say if you have arrived at an intrinsic value of a stock, and if it is, let's say, 10 rupees, so margin of safety says that you can buy it for roughly around 6 or 7 rupees, or maybe if you have greater the discount from its true intrinsic value, greater is your the principal protected from downside risk. And the reason why he gave so much of importance to the margin of safety is because future is uncertain, and there are lot many events that can happen wherein we don't have any control over that. And to take care of all those unforeseen circumstance, or unforeseen situations and all, to ensure that your principal is protected, margin of safety is very important. And basically he has defined specifically the concept of margin of safety for both bonds as well as stocks. And basically, Graham started as a bond analyst when he started his career in Wall Street. So that is the reason he was trying to, consolidate this entire concept of margin of safety. And during that times, all the stocks were regarded speculative in nature, and all bonds were only considered for investing purpose. And then Graham said that should not be the actual criteria. So there are few stocks, which are, if they are trading at less than their intrinsic value, then they can still be considered for investment. And there would be some cases wherein the company which is issuing bonds may not be in a healthy state, or good financial state, so that it can honor its payments and obligations. So in that case, even that bond may not be of investing so the bond may not qualify for that investment. So basically, he has defined criteria for both bonds as well as stocks. So I'll just read it out as I mentioned in the second graph, or second diagram of this slide, that for a bond to have a margin of safety, what Graham had mentioned was that if the operating earnings is more than the fixed five times the fixed charges. So basically, if the earnings from core operations, or now as we call it as EBITDA, that is earning before interest, taxes, and depreciation, amortization. So if those earnings are greater than five times what the company is paying for its for the loan basically that it has taken, so if it is more than five times, so you have a sufficient you know uh, 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 cushion, or basically the margin of safety exists. And basically what he was trying is now is called as interest coverage ratio. So that is nothing but the same thing. So for a bond, it was pretty simple that if that cushion is there for like five times if fixed charges, then maybe you can be rest assured that the margin of safety exists in that particular bond. For stock, it was quite challenging because stock doesn't have any obligation like a bond. So basically, what he had finally arrived was that if a price of a share is less than its net current assets per share, then you can be assured that there exists a margin of safety for that particular stock. So basically, what he was trying to do was that he did not pay any attention to a company's property, plant, or equipment, which are basically your long-term assets, and he was just looking at net current assets, which is nothing but your current assets like working capital, or the your all those things. And then from that you subtract all the liabilities, including short term, long term, everything. And if you get a positive number, and if you are getting that number, and if that number is less than two-third of its if the price is less than two-third of that particular number, then you can be assured that there exists a margin of safety for that. And second, which was quite easier as compared to the first one, was that if a stock is trading at a low price to earnings ratio. And again, this was way back when he wrote it in Security Analysis Intelligent Investor, because that times the stocks were usually they were reeling under the effects of this great market crash, and they were actually considered very speculative in nature. So they used to trade at a P of less than two. I mean, they used to trade at a P of 2 3, not more than that. And that is why so one thing that we need to keep in mind is that we cannot just now that the book was written way back in uh, the 1934 and all. So one should understand the concept, and just not just that the if a stock is trading at a low PE, just go and buy it. As I mentioned in my previous videos and all, that one should not just there is no magic formula, to be very honest. So there is not that one formula would work in all the scenarios and all, but then one should understand the concept, that what exactly was Ben was trying to say. So one should look for the margin of safety, and for him, he has put it into a mathematical equation that if price is less than its net current asset, then you can be sure. And if a stock is trading at a low P ratio, then also the margin of safety exists. So the common rationale of this was that basically he was looking for stocks that were not in favor, that were temporarily under, that was suffering temporarily, that were having some business problems which were temporary in nature and all. So, or usually it happens when there is a general bear market which is happening. So that is what I have mentioned in my second point, that he proposed these two techniques for purchasing a stock. That is, one should purchase shares of companies with good future prospects when the overall market is low. So when the overall, when there is, so let's say 1929 to 32, when the overall market plunged like in 80, 89, 90%. So maybe then was the time, once the market have crashed, then the margin of safety exists basically. Or the second is that purchase when the stock is trading at a significant discount towards intrinsic value, even though the markets are not significantly cheap. And that is what he is referring to, a stock with a low P ratio. So that was all about Ben Graham. Let's go to the next great investor, which is who is Philip Fisher. And again, he is like the exact opposite of Ben Graham, and he was more into, he was more into qualitative aspects of a business rather than. So Ben Graham was basically into quantitative aspects, and he did not pay much attention to a business management or a products or a services. So he was basically looking for a company's balance sheet and all the corporate filings that they were doing it with the Securities and Exchange Commission. Whereas Philip Fisher was just the opposite of Ben Graham, that he was, he was on the lookout for companies that can create wealth, that have, great business characteristics and outstanding management. So basically what he used to do was, he deployed an approach called scuttlebutt, wherein he used to talk to companies, competitors, suppliers, and customers, and ex-employees, current employees, and the various research scientists and trade executives. And so basically any source that he can have to get information. So basically his point was that one should not just invest by looking at a balance sheet or financial statement, but then directly go and talk to the management, or see how the management is behaving, or how, so basically he used to contact various sources, and then take a exhaustive survey of each of these people, and then arrive at a conclusion. So basically what he has done in his book called Common Stocks and Uncommon Profits, that he had created a 15-point system, and which basically emphasizes his philosophy, and it is more of a qualitative assessment, wherein he doesn't talk much about these key financial numbers, like, price to earnings ratio, or return on capital employed, or return on equity and all. So he doesn't talk much about that. Rather, he focuses on that, whether, so I'll read out few of the 15 points. So I've not covered everything. I've just highlighted few of the 15 points that Phil Fisher spoke about or talked about in his book. So basically, he's looking for a company which is having enough market potential for its products and services to ensure growth in sales and profit. Is the management determined to continue exploiting? So basically, what he's saying, that is the management, is it determined to continuing exploit the market potential once its current products or services are no longer in use? So does the management have any plan in future, so that for developing new products or services, so that they are still in the race, still ahead in the game of still ahead in the game, still ahead of the competition? And does the company have fair policies so that employees can deliver to their true potential? And does the company have enough profit margin to create value for its shareholders? And is the management capable, honest enough, and candid in their communication? So all these things, I think one can read, wherein he has explained it in great detail in his book. And the key point here is that he, instead of focusing on, as I mentioned, in the balance sheet and all these numbers and all, he used to focus more on the qualitative aspect of a business, like what we can learn from each of these sources to arrive at a fair conclusion. And then he said that if one has identified such sort of company wherein it has an edge over its competitors regarding the qualitative part, then one should just hold such companies for a long period of time. And then he has also stressed the importance of patience and discipline if one needs to create wealth over a long period of time. So that was all about Philip Fisher. And as I mentioned, if you need further information on that, I would really recommend, as I've already recommended in most of my videos as well, that one should read his book called Common Stocks and Uncommon Profits, which is also considered as Bible for growth investors. So let's go to the third and the last investor for this video, who is John Maynard Keynes. And he is a very interesting personality as compared to other two, because as we know that he was a great economist and all, but then his life as an investor is not highlighted much. And then one of the and he started his basically I mean, he participated in the capital markets as a speculator, and he used to speculate heavily in the commodities and currencies. And since he was an economist, and he has also written he has also written some great books on economics post the first World War ended. And because of that, his belief that his superior knowledge of economic cycles would provide him the edge to prevail over the others. So basically, what he used to think was that if he knows that when the economic cycle is, when there is a credit, when there is a boom which is going to happen, and when there is, the bubble is about to burst, so he can take advantage of the timing the market, right? So he used to believe in that, because he used to think that, he, as a economist, he has an edge, he has a certain edge over the others, which should help him create wealth over a long period of time. But then all these things, all his beliefs were shattered, and he was, quite he was very much humbled after this great market crash. And as I mentioned in the third point, that this crash had a chastening effect on him, transforming him into a value investor. And like Graham, he too understood that a business underlying value is different from its price. And subsequently, he also tried to calculate a fair value of a business, also called it intrinsic value. And in all these things, so the one of the important or one of the key aspects of his investing was that he used to practice value investing with a focused portfolio. And when I say focused portfolio, means that all of his worth was, let's say 70 to 80% of his allocation was done in his top five, six, seven ideas. And that is what we have seen these investors like Warren Buffett and Charlie Munger. So basically, all these things had a great effect on the upcoming investors. And and because of his concentrated approach towards portfolio allocation, his overall portfolio had a huge standard deviation, which is also known as volatility in market parlance. And his portfolio had a he had a huge volatility as compared to the UK equity market, which was basically the market index. And the I think it was roughly around 20 to 29% standard deviation as compared to markets volatility of 15 to 16%. But then over the long term, over 18 years of him managing the fund, he outperformed the UK markets, wherein his fund gave a performance of 5x, and the UK markets had negative returns of 15% over these 18 years. So we can see that, although in the short term the fund may have great volatility, but then over the long period of time, it had delivered great returns. So guys, that was all about this particular video. And basically, the reason I've made this, as I mentioned earlier, that there are lot many things that we can learn from these great investors. And in part one, I have covered these people because they are the ones, who can be treated like as a modern, the initial participants of modern financial markets. And subsequently, then we have investors like Warren Buffett, Charlie Munger, Seth Klarman, Bill Miller, Peter Lynch. So all these great investors are also there. But then these people, the ones which I've highlighted in this video, are the ones actually who have witnessed these events that have happened in the that were very much crucial from history, from history perspective, as well as from capital market perspective as well. So if you have any doubts, or if you want me to make a video on any of the concept that that you want to understand or something, or if you have anything which you have not understood in this particular video, do let me know in the comment section, and I'll be very happy to help you out. So thanks for your time, guys, and thank you, and have a nice day.